Hi everyone, I'm Artur and welcome to Reimagine 2020. Today I have with me Brian from Kava and Nicholas from Terra protocol. So, and obviously the topic is stablecoins and the parabolic rise that we've seen this year. So why don't I just hand it off to you guys? Why don't we start with some brief introductions about who you are and what your company does?
Sure, I'll take it.
You go first. You go.
Yeah, okay. Hi, I'm Brian Kerr. I'm the CEO and co-founder of Kava Labs. Kava is a blockchain that we built on the Cosmos SDK. What Kava does is it provides cross-chain lending in the form of stablecoins to users who have digital assets that they can use as collateral. Recently, another project called Harvest, and Harvest is a money market also for cross-chain digital assets. My internet connection is saying it's not so good. Did I cut out there?
No,
okay.
All good. Nicolas, to you.
Yes, I'm Nicolas. I work as a researcher at Terraform Labs for the last year. Terraform Labs is a Korean-based decentralized stablecoin. We started by launching in the payment space, so that was the first area we tried to reach, and we did that through our main DApp, which is called Chai. It's a really simple gateway for consumers to use stablecoins. It launched in Korea about a year ago, and we have reached a bit more than 2 million users. And now we are considering expanding more generally in the DeFi space with the introduction of Anchor protocol, which will be live in about a month.
Interesting. And I mean, honestly, what both of you guys are doing separately deserves so much kind of digging into on their own. But I guess on the sort of in the broader picture, one of the trends definitely that we've seen happening kind of in the behind the scenes has been this massive growth of stablecoins. And while obviously stablecoins, they play such an important role in the, in just the usability of our ecosystem. What do you guys think has actually contributed to this massive rise that we've seen throughout this year?
I think undoubtedly it's been the advent of Compound and the success of DeFi protocols earlier this year. And you can kind of very easily see that in, like, if you look at Tether's chart or USDC's chart, the increases in the billions in terms of fiat-backed stablecoins that have been minted in this process. And that doesn't correlate necessarily with activity across the whole space and kind of people who own Bitcoin and everything else. It's been a pretty big divergence from Bitcoin being kind of the index for the whole space to now DeFi taking the lion's share of kind of stablecoin trading and activity there. So if you just look at kind of Bitcoin's price chart and look at the stablecoin total supply charts, they used to correlate as of March of this year. They don't anymore. And the big parabolic move in stablecoins has been because now there's these great yield earning opportunities in DeFi protocols like Compound. And then kind of on the back of that have come very, very large increases in things like DAI, which as Compound grew in popularity, grew in attention, and the whole world started looking at DeFi as the new place for yields. DAI also grew from its 100 million that it was 6 to 12 months ago to how big it is now today. So I think we're seeing kind of the whole growth of the space really be driven by yields, and those yields are being given to everyone by DeFi.
I fully agree with the general observation about why this has happened and what the driver has been. Terra specifically has not really participated in the DeFi craziness up to now. So most of our success came through user adoption, which in our context, it happened. If you want to use a credit card online, for instance, you have to pay a 2.5% to 3% fee. So we decided that if you do that via the blockchain with a stablecoin, you can actually save a lot of money. So the product we offer to merchants charges something like 0.5% to 0.75% versus a credit card that would charge like 2.5% to 3%. So giving these sweet incentives to merchants made them co-fund some of our promotions. And that's what really drove our adoption. But yeah, if we're going to make a general observation about the stablecoin space, I fully agree that the rise of DeFi and the chase of arbitrage is what has driven that massive adoption.
Yeah, and I don't think that either of us have, our projects have necessarily caught that wave. Well, my with Kava, we're focused on allowing people to get loans, which is used for leverage trading. Maybe it's helpful to say Kava is used for the use case of speculation and trading, where you guys are definitely more on the payment side, and you've seen a lot of traction there. And I think the natural evolution is we're going to see a lot of kind of the stablecoin activity, a lot of improvements in the stablecoin infrastructure, and then from that, we're actually going to see an uptick in payments, which you guys are already on the sort of forefront of, because it's just sort of the natural progression. With more people having stable coins, more people are going to eventually use them as payments, and more people are going to accept them as a form of payment. And I should call out one of our partners, which is Swipe, but they've launched a debit card that anyone can hold digital assets in, and then now they have Visa cards that they can spend off of freely. That technology or that infrastructure has existed for years for Bitcoin and other things with Shift card and a bunch of other payment cards. But it's only now really interesting because stable coins offer native yields when you hold them. You can now get 4%, 5%, sometimes 10%. And that's really cool if you can have a debit card where you can spend it in 60 million merchants worldwide, just like you would cash in your checking account. And I think that's the really big shift, at least from my view, in the payment spaces. Now we finally have the infrastructure where stablecoins can be used as payments. And whereas in like 2018, payments were interesting as a kind of technology for blockchain, or application for blockchain technology, but there wasn't any volume or traction for that to be really interesting and drive kind of real world adoption. But I think that shift is now happening, where payments can really take off.
What you correctly mentioned, which I think is an interesting factor to the adoption we're seeing, is the fact that interest rates are historically so low. So when you can have a stable coin that offers a slightly higher yield by holding it, I think that can really give a powerful incentive towards adoption. And at least that's our main consideration, where we are considering expanding more in the DeFi space. If we could find a way to organically offer some yield to the people who hold their stablecoin, we believe it's going to be an extremely powerful incentive towards mass adoption.
Yeah, and the challenge that we have, so on Kava, people can deposit Bitcoin or BNB as collateral, and then mint our stablecoin USDX, and USDX offers a native 4.5% rate for anyone who holds it. You don't need to lock it up in a smart contract or anything. Just it starts getting paid out to your account. Well, where does that come from? It comes from the person who borrowed it to buy more BNB or get a leveraged position, and they pay that interest rate to the protocol, but that ultimately just gets paid out to whoever's holding the USDX at the end of the day. So it does create this extra demand for a stablecoin. The downside of these types of systems is, unlike the real world where banks can just create more dollars, we have to find borrowers to pay that interest rate before we can make USDX. So in many ways, supply of these stablecoins is one of the primary factors for how big can we grow and how fast.
And I think like one of the things that I'm really noticing here as well is that like you guys have mentioned, you're both tackling kind of different ends of a stablecoins usage. But I think for the past multiple years, as long as anyone's been working on stablecoins, the problem has been that where do you start, right? That the expectation for money is that it's universally acceptable for any purpose, right? And previously just it's either something that you can use for trading, but you can't use it for payments and so on. So do you guys feel that, or it seems to me that like finally the kind of like the circle is starting to close, and we're starting to, you know, the infrastructure is starting to get there that it's actually usable. But my question would be that so you guys both essentially work on decentralized stablecoins, right? But a lot of the growth that we've seen this year has been, like Tether, you mentioned, has been in centralized stablecoins. Why do you think why do you think that is?
Do you want to go first?
I don't have an extremely sophisticated answer to that. I would expect that the main driver has been arbitrage, especially with the 1,000 liquidity pools that open up every day. It has created a lot of opportunities to make some good yield via arbitrage. So that's what I see as the main use case that has driven most of the adoption up to today. That doesn't mean that I say that's what's going to be going forward, but yeah, if I'm going to make a historical assessment, that would be my best guess.
I think one of the most interesting data points that we can look at that actually leaves me scratching my head a little bit is that they've done polls, and it's been shown that most of the people in the crypto space are the same people that were in a few years ago. And the overall space in terms of traders and people who hold digital assets hasn't really grown all that much. So the pie is roughly the same. But what's really interesting is the stablecoin side of things has grown dramatically. So where is that capital coming from? You know, if it's coming from the same people, did they just get a bunch more money now? I'm not sure. I don't know what that means. Those are two very, those are two data points at odds, at least in my mind, and how I look at things. I would say, you know, it seems like all the crypto funds that have survived might have a lot of capital and they're just deploying their cash now. But, you know, maybe one explanation is that while they're fine, the larger, you know, financial institutions and crypto funds are fine taking, you know, some amount of Bitcoin risk, some amount of early project risk, they tend to always have a cash position to deploy. And what the advent of DeFi has actually enabled them to do is to use their cash without taking a view long Bitcoin, short Bitcoin, or anything like that. They keep it denominated in what their fund is denominated in, USD, but now they can start generating yields off of it. So that maybe, you know, that as a just talking out loud and brainstorming, that seems to be a plausible explanation of what we've seen. And that actually matches up with what I've seen in just terms of my peer set from people I know. A lot of the early stage funds have just said, you know, I'm not going to do early stage anymore. The risk is too high if a project's going to be successful or not. Right now, it's so much easier just to deploy all my cash and earn a yield on compound with the digital assets I already hold. I don't need to, you know, be more long exposed or short exposed, but what I am accepting is just a little bit more technical risk that compound's going to be okay.
Right, and but I think, like, actually one interesting point is that if you look at the trends, or when Tether, for example, started essentially stacking billions onto its AUM, it was before yield farming came around. And I know there's a lot of conspiracies around Tether, but one of them has also been that it's become an incredibly efficient method of a simple payments network, or like a remittance network, and specifically across in and out of China, because it's sort of, you know, it kind of doesn't obey to traditional internet borders, as some countries do have internet borders. What are you guys' thoughts on that? On kind of like, you know, stablecoins being starting to get used, not necessarily as like a rail to enter or exit crypto, but actually as like as that someone can be a stablecoin user but never really care about Bitcoin.
I'm very, very skeptical of that particular user. That Tether is being used to, you know, pay for goods and services from China trading with Russia or something like that. It's possible, but there has to be some interaction of those customers also accepting digital assets. Otherwise, it's kind of odd to me that they would be on exchanges where they can have that on-ramp and off-ramp. I just don't see that natural user adoption flow. But maybe that's true. I don't live in Russia, so I don't know. But that's where at least Tether's claiming a lot of the payments uses are happening. in kind of these countries that don't or are not served well by the current US banking system.
In the case of Tether also, like it was a great tool for many of the exchanges to bypass a lot of regulations and get access to liquidity, which they need to be able to market make, to be able to make sure all the operations run smoothly. So Tether was the much needed liquidity provision that many exchanges across the world have been needing, and because of regulations could not really get access to. But about the hypothesis of having a crypto user who will only use a stablecoin and never get exposed to Bitcoin, Ethereum, all the other real coins, I'm actually quite optimistic about that. So I would say that a big part of our user base is this type of user. So the way we operate it is you just connect your iPhone, your phone to an app, and then we are your custodials. And you, at no point you actually realize you're dealing with crypto. It all happens on the back end. And at least from an adoption perspective, we saw that that was extremely powerful, like setting an incentive scheme, an infrastructure where someone like our grandmother could be using crypto and not realizing. At least personally, that's where I see a big part of the space going forward. Because as you correctly mentioned, still most people in the crypto space is the old crowd. They are not like new users. And if we really want to increase the total pie, I think it's crucial to make barriers to adoption less severe. So that's my hope, at least, that's where the industry will be heading in the next few years, if regulation permits us, at least.
I think there's a really interesting observation to be made, which is even in your use case, you guys are the custodian. We're seeing traders all over the world actually custody their funds more and more on exchanges like Coinbase and Binance. And they're trusting Huobi holds the most Bitcoin, I think, of any exchange. And then in DeFi, we're seeing, a lot of these DeFi protocols are actually opting to be a bit more centralized for speed and go to market and other things. Kava is not, an exception to that. But it's because the overall market is no longer this dogmatic, philosophical, everything has to be 100% trustless, otherwise I don't touch it. My keys, my crypto, that kind of mentality. It's actually, where do I get the best user experience and the best yield? And people are actually very fine giving, their crypto, allowing you guys to custody it and everything else. I think that's the surprise to the whole industry, is that it's not about the trustless nature and it's not about holding your keys. That matters to only the small technical crowd, but that's a very small portion of the world. What matters to everyone else is like, what is the experience like? What is the utility I get? What is the yield I can generate? And that's what they really care about. And I think that's just been a huge learning across the entire space.
Yeah, in full agreement.
Definitely. And I think the stablecoin interest rates is something that I think it very well can be the thing that that attracts the next million people into crypto, because as Nicholas also mentioned, the essentially a zero interest rate climate makes any yield above zero very attractive, and crypto's kind of nature and this constant lack of some stablecoin liquidity somewhere just creates this kind of growing supply also of I guess yield. What are your guys' thoughts? And I guess with regards to this sort of a new trend that we've started to see now more and more is this CDeFi, or like centralized exchanges integrating DeFi protocols, DeFi projects, and in different ways. What are your thoughts? Is that like a Trojan horse that's out to ruin DeFi, or is this like a pie gets bigger sort of situation?
I personally don't see centralization as something inherently bad. It just, in some cases, it helps setting better incentives, or just outreach. In the example you just mentioned, like having a lot of exchanges participating in DeFi projects just increases the outreach of such projects, because I think that there is like a self-selection across crypto users. There are the crypto users who will go into yield farming. They will go and do all of the things themselves, and there are the more lazy type of, or like the less interested type of crypto users who just prefer to delegate their crypto and let someone else do it. So I see a really natural space for some degree of centralization within the crypto community.
Yeah, I agree. I don't think centralization is inherently bad. Of course, some of the dogmatic people would disagree, from especially the hardcore crypto Bitcoiners from 2013. But what we're seeing is with these centralized exchanges like Binance, when they integrate Kava, they removed a lot of the difficult user experience. They simplified it, and they presented it in a way that their users wanted and they could understand, where they didn't have to manage their private keys. They didn't need to figure out how to get a ledger, create a BNB wallet or anything else. They just have to click a button and they're participating and using Kava on the back end. It's really beautiful. And I think how I think of at least DeFi protocols today is they really are just like financial products and services. Just like a bank has a bunch of core banking services, like sending a payment, like a checking account, a savings account, a mortgage, whatever. You should think of DeFi protocols the same way. It should be, do you want to lend on Compound? Do you want to borrow on Compound? Do you want to mint USDX with your digital assets? Do you want to stake your Kava tokens? They're just financial products that these platforms are offering. And that's why I at least believe that the whole industry is moving much more mainstream right now on the backs of everything. And I fully expect challenger banks, maybe not the large banks just yet, but challenger banks to start offering stablecoin savings accounts that offer better yields to their customers, where they can send dollars to that bank. But if it's a paycheck or whatever, they can just deposit it, and they just automatically convert it for their users to stablecoins. I think that's going to be a natural evolution of this space. And then on the back of that, which is a very pure product, then they're going to add all this weird you can deposit your digital assets, be a liquidity provider, and then earn a governance token. And that's an effective yield. It's not pure one-for-one yield in the asset that you're lending with, but you're earning this effective yield off of the governance token, which you then sell. I think that's going to just continue to be more and more a thing that people want to offer, whether they're a challenger bank or a fintech app like Robinhood or whatever else. Like, I can easily see this in a 1 to 2 years being much more widespread and not just limited to crypto exchange integrations.
Nicholas, anything to add?
We are in agreement there.
Awesome. But Brian, where do you think do you think I guess the two sides of essentially offering yield is you need the supply of dollars and the demand in this case in terms of loans. The situation that the future that you described, let's say like Robinhood taking or a Robinhood offering a yield product to its customers. Are we there yet today? Is it possible for someone the size of Robinhood's customer base to we're talking, because I guess we're talking about inflows in the in the hundreds of millions on a weekly basis, right? What is the today's market size of this of the let's say like a stable coin yield market?
Yeah, the size of what Robinhood would need is huge. But if I actually sat in line. They make you sign up on Robinhood to say, hey, do you want a cash account that offers 0.3% yield? It's like, wow, that's better than a checking account. Sure, I'll sit in line. And like, great, you're in line of 2 million people, and it slowly ticks down every day as they unlock more of these cash accounts for their users. But just like the yields in DeFi, where we connect interest paid by borrowers to these stable coins, similarly, Robinhood needs to source their yield from somewhere. They have products on the back end that they're generating. They just can't mint dollars out of thin air. So they just rate limit how many users can access it. And I think similar for DeFi, it'll just be applied in the same way. It's like if you're a tier 1 Robinhood user, you might get to the front of the line a bit sooner or something. But they're not going to open up to everyone, because if everyone converted the dollars that they have in these investing apps, the whole crypto space would be tapped out right away. And it's not like if they buy a stable coin, it actually grows the market cap of crypto. It doesn't. If they buy Bitcoin, it does, because the price moves up. But stable coins, that's not the case. So I think we'll see these kind of metered approaches as adoption happens, and these integrations happen a bit more. And hopefully, since we're talking about Robinhood, if Robinhood did expand their crypto offering to integrations where users could borrow for margin to trade crypto assets, that would actually grow the stablecoin pie as well, and they could both grow in tandem. Will that happen? Probably not. It's probably going to be one or the other first, and they're going to take baby steps because they're regulated and a pretty large institution in the space, really controlling a lot. So I would say there's a lot of opportunity, but who's going to be the first mover that's really going to drive the needle for the overall space? It's really hard to say. It could be anyone.
A concern I have about borrowing and lending in the crypto space, and I would be interested to also hear how you guys think about that, is that credit demand and credit supply, as in traditional finance, but especially in crypto, are highly linked to the underlying collateral prices. So for instance, in the case of Compound, we can say that Ethereum like price changes can have a massive impact on yields that can be produced. So when we were considering how we can create a borrowing and lending product, that's something we want to target. We want to have a stable rate, which is something that it's not that much the case, at least for most protocols right now. So our way around it would be to try to subsidize the rate in a counter-cyclical fashion using staking returns. So if you could somehow stake the underlying collateral, you'll also have an interest yielding product on top of your loan, and you could use that interest to either subsidize the borrower or the lender to kind of smooth the fluctuations. I'm just curious. I'm not too aware on Kava specifically, but is it something you have considered, or generally how to deal with the fluctuations in demand and in turn the rates?
Yeah, we've had huge swings where we had, we've only launched with one asset so far, which is BNB. On October 15th, we expanded to many assets. So the considerations will be a little different then, but at least from what we've seen with BNB, it's swung up to the north of $50 million, and then that's 1% of all BNB deposit in Kava, and then down to 25. So there's very big swings in kind of the borrowers in quantity, largely because they just chase yield as well. So if a better yield opportunity comes somewhere else, then they're going to move their assets and realize it over there. And my favorite phrase that I've heard in the past few months is there's no loyalty in yield. And that's absolutely true, whether it's FX or commodities or crypto. People are going to move capital if they can get a better return elsewhere. But in Kava, at least for the harvest money markets, it's a market rate. And for the stability fee that's paid on the Kava lending platform, that's set by governance, and it's pretty straightforward. But again, it's supply limited. So as supply goes up and down, the rate stays the same, but the amount of USDX stablecoins that's available is going to grow and shrink along with it. So it's not something that we can have a huge amount of control over. We can increase the rates or decrease the rates to drive more borrowers, or reduce the borrowers depending on the scenario, just like a central bank increases interest rates up and down. But that's a very active management approach. And I think you only want to do that once you're really swinging in one direction or the other a bit too hard. I don't know if that answers your question completely, but we kind of approach kind of the lending side a bit different than the harvest money market, which is just purely a market rate.
Moving on to a different topic that word that has been used here is regulations. What do you guys general thoughts there? Like, obviously, there's reasons behind regulations. There's cases where the regulation just really doesn't carry its purpose, where it stifles innovation, and then there's kind of a lot of other options. What are your thoughts on how do regulations kind of impact stable coins, decentralized stable coins, and so on?
I think that's the main existential threat of stable coins right now. Like be 100% sure that they're in compliance with regulatory authorities. So in our case, getting the banking license for the main DApp in our network for Chai was quite a struggle in the beginning. But Korea at least has offered, is one of the few countries that has provided a pretty clear regulatory framework. It's not active yet, but it passed through the legislation, so it will be implemented in the next few months. So at least for us, that gives us a lot of confidence, because for a big part of our existence, we operate a little bit on a gray area, since some things were not clearly written in the law. And yeah, I think having clear regulation and a friendly regulatory environment is the biggest prerequisite for any stablecoin projects to succeed. And the fall of Basis, I think, illustrates that in a really nice way.
There's actually a really, since you mentioned Basis, so for people who don't know, Basis was a algorithmic, or I don't know, would it be Demirage shares is maybe the better term for it, but it is algorithmic stable coin, which used a bond market to stay stable. But the founders who made that, after raising a lot of money, gave all the money back because they said the regulation was just too heavy or too high to overcome. But what's really interesting is two anonymous characters by the name of, I think it was like DeFi Rick and DeFi Morty, have appeared and made a fork of Basis recently. And they pushed that forward, and they've been doing some, they've just done it completely off the normal, make a company, create the product. They're just like, we're just going to be anonymous characters, submit the open source code, and let it go from there on the back of all this DeFi madness. It'll be really interesting to see if this like DeFi fork of Basis is going to take off or not. But that we haven't seen anything similar since. But Basis was one of the really, really interesting projects. But as Nicholas mentioned, it just got crushed by kind of the lawyers and the regulators. There's just not a lot of routes for a real company in the US to do much there.
And from personal experience, I can tell that our main roadblock with regards to the US markets has been regulation, because our current operating model in Korea, it's not clear to what extent it would be 100% legal and in compliance in a US market.
Yeah. There's so much just in terms of cost that comes along with just doing anything in the US, with FinCEN and all the other regulations that come along, from being a money transmitter, from being a bank, from being, there's just so much there. It's, almost prohibitive, but there is a, light at the end of the tunnel, because now there are banking licenses being issued, with Kraken being one of the first exchanges to get a banking charter for digital assets. They just got it, so nothing has really happened yet. But that is positive news, at least for the space, that there's, as you said, just having a pathway of what are the steps that you need to take is a huge part of that hurdle. And it was just unclear up until a little while ago.
And I guess, so you mentioned I guess legitimization happening kind of gradually, and I would agree that technically regulation that is the potentially existential threat, but at the same time it functions as a potential stamp of approval for a lot of people, that the majority of the world, they do not put their money into something that says, this is beta, do not use, you might risk your funds, right? Well, we live in this industry where everyone decides to basically YOLO and put all their money into this thing because it promises a very high yield, right? So we do live in a kind of abnormal world. But what are you guys' thoughts on Libra, which is, I know, super buzzword and so on. Haven't heard about it for a while, but I was thinking very relevant for this discussion.
Oh, first I would like to be honest, the last topic though, really quick, which was just the existential threat that Nicholas mentioned. I think it doesn't get talked about enough in the crypto space that Tether, which is the primary liquidity device of the entire space, is all held at one bank in the Bahamas. And if that gets shut down, the whole crypto space could just explode. Like BTC could go down to, I don't know, 1. You know, it might, I don't think it'll go down to absolute 0, but it's going to go way, way, way down. And that's going to set back the entire space. Yes, there's USDC and other regulated options that are that could take its place, but it's not going to happen overnight. And the whole space is going to get such a market cap hit that people just aren't going to have the funds and liquidity, and everyone's going to get squeezed out of their positions. It would be such a hit to the entire space, and people don't realize just that could be even the decision of just the CEO over at Deltec Bank saying, nope, I don't want Bank Tether anymore. That could just be boom, Tether's done. It's really just hanging on a thread at all times. And Tether's also gone under a ton of lawsuits and other things that they've fought off. And it's amazing how much FUD has happened around Tether, and it still exists. And that's why I'm actually kind of bullish on Tether. Liquidity begets liquidity, and Tether's maintained its position. But we should just all remember that there's still a pretty big possibility that crypto goes to kind of 0. And it's all hanging on Tether right now.
On a slightly more positive note on that subject, we have noticed that Tether dominance has been declining a lot over time.
That's true. So it's true.
A really healthy development is that we see more and more stable coins being created, and different stable coins have different niche use cases. Of course, Tether still has the arbitrage use case, which still is the dominant use case of stable coins. But I think it's a healthy development that there has been some competition across different networks with regards to stable coins, and hopefully that's the future going forward.
Yeah, you need to have these alternatives to take the place if and when that does happen. And I actually largely think of decentralized stablecoins, like what we're doing. We're kind of sitting there like waiting. We're not ever going to be the #1 stablecoin, but if that does happen, or if regulation does change to a more negative tune, that's when decentralized stablecoins can really take off as well, because that's when people just have to use them.
And I guess just to add to this is that, technically, I think Tether and USDC are both regulated in under the same bucket, right? They're both was it FINRA registered, and that's it.
Well, Tether's a little different. I mean, there's a lot of different places where Tether's fighting battles in different jurisdictions. And I think it's hard to say, because what Tether does really well is it kind of maintains this gray space, almost like a Binance-esque, like people are throwing rocks and bullets at it, and it just sort of deflecting them off and not being injured somehow. But it had this undercapitalized part where some of the crypto that they had got given to a third party, and then the funds were, quote unquote, lost. So it wasn't even 1-for-1 backed. Then they did the Leo raise, which apparently recapitalized it, but no one really knows. There's all sorts of things that, whether it's regulated by X, Y, or Z, I think ultimately, just like money, comes down to, do people have faith in Tether? It could be regulation that cuts away, what people believe Tether to be. But I could see actually Deltec Bank saying, nope, no more Tether, and then people still want to trade it and think of it as real dollars. It's really interesting in that way. It's all that kind of belief in the money. Does it have value?
I mean, if you think about it, all money is a bubble. It's a subject of how we value them. If we think something has a value, it has a value. So same thing with Tether.
But I think the thing about what helps with Deltec Bank is the ownership structure of it is kind of pretty pro Tether as well. If I remember the founding story of it correct, that it's kind of similar group of people involved with it.
Well, I'll tell you a funny story. Actually, the owner of Deltec Bank is actually the inventor of Inspector Gadget. And he made a lot of his money as Inspector Gadget, and then rolled some of that money into doing, developing some properties in the Bahamas, and by kind of doing that good and building up the community, he was able to get, work with the government and get a bank charter, and that's how Deltec Bank got formed. And then when Tether got kicked out of all the other banks, they went to the Bahamas because it's one of the few places that there was a bank willing to work with them. It was the largest bank in the Caribbean, but they what's really nice about the Bahamas, and it's actually why Kava banks there amongst other banks, is because the regulatory risk is a bit nicer. It's very hard to have your funds shut down there because it's not like an English common law place. If the UK or the US says, hey, stop doing something, it has to go through kind of the country's government process before it ever reaches kind of the bank, and the bank has to lock funds of someone. So it's actually pretty nice and insulated from other regulations or other jurisdictions. I don't know what they're called, but not warrants, but basically like seizing funds and that kind of thing. It's a bit more resistant to that.
I thought there was a Brock Pierce involvement in Deltec Bank as well. But anyways,
there's a bit of that, and also along with the owners of Bitfinex, they're all kind of in the same group with Deltec.
I'm sure they have an interest to get along well. Zooming out of that, I'd like to just briefly talk about the technical side as well of stablecoins. What a commonality between both of your protocols is that you're both built on the Cosmos SDK. Due to its nature, today still both of your projects are essentially standalone blockchains. There is this thing IBC. It's been coming on the horizon. What are your thoughts on that? And maybe one of you could sort of explain what IBC is to a dummy like me as well.
Let you have that one.
In a really simple way, it's pretty much us figuring out that if we pull together our resources and be more and more interoperable, we can achieve greater things. So in one sentence, that's how I would summarize it. So different projects within the Cosmos ecosystem have different niches. So we thought that it would be good if we develop a closer collaboration and see how we can complement each other by taking into advantage all of our different strength points. So for instance, we do a lot of payments. Kava has done a lot of borrowing and lending. We can definitely use each other's knowledge on different spaces and collaborate to reach a greater audience. In one sentence, that's how I would summarize the goal of the IBC.
And
yeah, there's always I'll just add, there's always a trade-off every blockchain has to make in scalability, throughput, its specialization. If you're doing privacy, there's a lot more compute involved. What IBC allows for is for blockchains to specialize into one thing or a few things that they're good at, but then interoperate with other blockchains for other services, whether it be Oracle data or something else. And yeah, what's also really nice about the Cosmos ecosystem is because they're all designed roughly the same as proof of stake networks. All of it, programmed in Go. It's very, I can develop something, or Kava can develop something. We open source it. Terra, if they like that, they can be like, cool, I'll use that, and they just pour it over. So similar to how Ethereum, you can fork code and do that. It's not just that Cosmos has one team developing on the SDK. Like Kava, actually, we pushed some code, some of our like vesting accounts and other things directly to the Cosmos SDK. So there's many teams. There's us, there's Terra, there's Akash, there's Binance, there's now OKChain and KuCoin all developing. There's over 100 projects developing on the Cosmos SDK. And I just think of it as like rapid experimentation and evolution all at the same time. People can just grow from that. So it's like you have 100 businesses collaborating on their resources and growing very fast because of it.
And you also make it easier to attract a new developer talent in each chain, because right now it's pretty known that Ethereum has taken most of the engineers, but that's slowly changing, I believe.
Right. And I guess we're almost out of time here, and I'll start to wrap this up. One thing which I'd like to, I'd be interested to hear is what are the kind of what is the thing in your opinion that should be talked more about when it comes to stablecoins? And Brian, I'm not sure whether you already answered that question just now about Tether, but
I'll add one. What should be talked more about is this ridiculous notion that people have to hold Ethereum to pay for gas, regardless of gas fees. It's just a huge roadblock to the stablecoin use case is just needing to hold another token and needing to have people manage whatever that price or risk or volatility is. It's just silly. And I think when you have a proof of stake blockchain like ours or like Terra, the validators, which get paid in the native tokens, can arbitrarily set those fees to roughly zero. And that just could be a thing of the past. Apps that develop and integrate these stablecoins don't need to manage multiple assets. If they want to just be the Venmo, but using stablecoins with crypto, they can do that. And people don't need to worry about holding Ethereum or anything else. And I think that is not talked about enough. So when I see like new stablecoin on Algorand or new stablecoin on X, Y, and Z blockchain, they're still suffering from the exact same thing, which is users have to hold two tokens. It's silly. It should be a thing of the past. And I think the industry really needs to move away from that.
And
do you see a way for Ethereum to ever get past that?
If Ethereum 2.0 Ethereum 2.0, maybe there's something there. Maybe there's layer 2 stuff that moves it off. If there's there's not going to be ever a need for settlement in some weird layer 2. I don't believe that's actually a reality, but it's possible that in a staking model somewhere in the future, I don't even think in Ethereum 2.0 it quite solves it. But of course, every network can evolve and iterate and upgrade. And if they see kind of the industry move away from Ethereum to other things because of that reason, you can bet that they would try their best to address it. The problem with Ethereum is that it just evolves so slow because it's such a big network now that it would take them years to make those adjustments.
Maybe 3.0 then.
Ethereum infinity.
Nicolas, what about you?
Just a quick point I wanted to make about most of the stablecoins. So there is a notion that for a stablecoin to be successful, has to be either backed with fiat or be over collateralized by other crypto. And I think that makes most stablecoins highly capital inefficient. So I'm a true believer that if you set up the right incentives and you have a proper monetary and fiscal policy, it's not much different than defending a peg of a country to have a stablecoin pegged to a fiat without having 100% the fiat behind it. So I think that's a framework of operation that more and more stablecoins should adopt going forward, because being capital efficient has significant gains with regards to both user adoption and setting up the right incentives at place. So I guess I would like to dispel that notion that for a stablecoin to be successful, it has to be either 100% backed by fiat or be over collateralized by other crypto. I don't think that's the case, and my hope is that the crypto space will, with some degree of prudence, move towards that direction.
Yeah, I guess that, would you say that needs credit then in that case?
Credit is definitely one of the really important drivers. At least that's what traditional economics would teach you.
Yeah.
Both great points, and I guess I'll end it there. Thank you guys so much, Nicolas from Terra and Brian from Kava. Once again, this has been a great discussion, and look forward to having more of these.
Yeah, thank you so much, Artur. It's been fun. Thank you, Nicolas.
Likewise. Have a great day.